Okay, so the types of budgets that we're going to look at, the following are some of the types of budgets that are commonly used by businesses to plan their future business activities. We spoke about your cash budget, where we say your cash budget actually deals with cash only, right? Where only cash transactions are looked at. And you would remember in grade 8, grade 9, you did cash receipts journal of a service business, as well as a cash payments journal for service business in grade 8, grade 9, cash receipt journal of a trading business and cash payments journal of a trading business. So cash budgets here, what are we talking about? It's a focus of the cash position of a business over a future period, which sets out the expected cash receipts and cash payments over the budget period. So as you are drawing up this budget, you are actually drawing up a budget that talks to what receipts are you expecting? How much cash do you expect to come into the business, and how much cash you expect to spend out of the business? So here we're looking at your income and expenditure. So that is the most important thing to look at in terms of this budget. And then we come to your projected income statement. When we look at your projected income statement, you would immediately understand that here we are actually going to be making predictions, okay, of what the business is going to be making, all right, in terms of income, what income is expected, and also what expenses are we going to incur, right? So a focus used to predict the amount of profit that a business will generate over a certain period, which sets out the expected income, so how much we expect to receive, and then how much we expect to incur in terms of costs. And then when we separate those, whatever that's left will be our profits. Then we look at your capital budget, a focus of the future expenditure on fixed assets. Okay, as we call it, your capital budget. Okay, capital meaning all the assets of the business as well. Right, so the focus is of the future expenditure on fixed assets. How much do we expect to spent on fixed assets of the business, which sets out the expected cost for purchasing, extending, and improving fixed assets over the budget period. So you must understand things such as your maintenance, purchasing of new fixed assets, such as your equipment, furniture, and many other things that you can think about. Then we go back to your zero-based budget, a budget of expenses. This is what we call your budget of expenses, in which each item must be justified, evaluated to determine whether or not it is required. So before we even spend on anything in a business, we need to first evaluate whether we will need it or not, because in that way we will be cutting the costs in the business. Right. So continuing with the types of budgets, we look at project-based budgets. In a business, we might embark on a particular budget. Now, in embarking in any in any project, not budget, but in any project, we need to ensure that that project that we embark on is going to meet certain or is going to actually fulfill certain expectations in the business, and then it will be of future benefit to the business. So we say project-based budget is a once-off budget that is prepared to evaluate the merits of a specific project, which sets out the cost involved with the project so that an assessment can be made against the expected future benefits from the project. Then again, we go back to the production budget. Now, look at it yourself. Production, right here, we'll be looking at all your fixed cost. We'll be looking at things such as your operational costs. We'll be talking about the raw materials and all of those things, okay? So production budgets, a focus of the costs involved in the manufacture of a specific product, which sets out the cost of the raw materials, labor, overheads, and all other production expenses that relate to manufacturing the product. Because in order for us to produce, we need to also spend. All right, because we need to spend on the raw materials, the labor, the overhead costs, and all of that. So that is why we're talking about your fixed cost, your variable cost, and then looking at your total production cost. Okay, and those are some of the things that we are actually talking about, thinking of in terms of production budget. So the production budget actually tells you exactly, it's all in the manufacturing process. So the cash budgets now, let's look at the cash budgets in a little more details. The cash budget is an essential tool used to monitor and plan the liquidity of the business. All right, so we're looking at the flow of the business. When preparing the cash budget, the most important word to remember is cash. Everything has to do with cash. No credits, nothing. Only future cash transactions, inflow and outflow of cash, are considered when drawing up a cash budget. Hence, we call it a cash budget. So a cash budget helps the management of a business to identify. I'm so sorry, let me just charge. The battery is about to die. Fast. Right. Oh my goodness. Please don't die on me. Right. So a cash budget helps the management of a business to identify whether the business will have sufficient liquidity, enough cash to be able to meet its short-term commitments, such as paying creditors and repaying loans, purchase stock, paying operating expenses. So if the cash budget of a business predicts a cash shortfall in a specific month, then the management of the business can make plans in advance to overcome this, such as by arranging an overdraft with the bank. Okay, because you can see that, okay, we have predicted, but then it seems we are going to have a shortfall. So what do we mean by predicting a shortfall? Less than what is expected. All right, so if you predict, so as you are making your budget, you find that the budget was not sufficient, there's going to be a shortfall, you should be able to see this in advance so that you can be able to quickly make some concessions. Right, so that is all in cash budget. Now the format of the cash budget, let's look at it. The cash budget is divided into the following sections. We've got your cash receipts, a prediction of the cash receipts. So you are predicting how much money you are going to receive in the business inflow for the budget period. Then cash payments, you also make predictions of the cash payments, how much you are going to be paying out of the business. So these are the outflow for the budget period. Then you are going to now look at cash surplus, the total cash receipts less total cash payments for the budget period. Okay, so from them, you're going to look, okay, will we have a surplus or we are going to have a deficit? Okay, so these are all the things that you're going to have to look at. So that is what we're talking about where we look at the shortfall. Are we going to have more than expected, or we might end up with less than we have after we have after we have separated our cash receipts and the cash payments? Right, so bank opening balance. Right, when we say bank opening balance, obviously from the previous month to the new month, you might have a certain balance that will be the opening balance. Right, the bank balance at the beginning of the budget period. Right, so at the beginning of a new period, or it could be the beginning of a new month and beginning of the new year, whatever, depending on how long the budget has been planned for. Right, so when you talk about the opening balance, we're talking about the balance at the beginning of the budget period, and the bank closing balance will be the expected bank balance at the end of the budget period. So you try to predict what is going to be the end balance of that particular budget period. So a cash surplus is an increase in cash arises when the expected cash receipts are greater than the expected cash payments for the budget period. Then a cash shortfall is a decrease in cash, and it is recorded if the expected cash payments exceed the expected cash receipts for the budget period. Now, let us look at the debtors collection schedule and creditors payment schedule. An important source of cash that must be determined when preparing a cash budget is the cash that is expected to be received by a business when its debtors settle their accounts. So that is what we're looking at when we look at the debtors collection schedule. Remember, we said here we're only talking cash. Now, remember, when we talk about debtors in a business, we have always said that debtors are an asset in a business. You would remember when you were dealing with your accounting equation, as well as when you were dealing with your general ledger. Whenever we spoke about debtors, we had something called your debtors control, okay? Debtors control, which is this debtors collection schedule, right, where you are able to actually see whether the business is going to make money through the money that's going to come from our settlements of debt from our debtors. Okay, so these people are our assets because they actually help the business grow. Since debtors usually pay their debts over a number of months, this calculation can be quite challenging. Therefore, this calculation is usually performed drawing up a debtors collection schedule before the cash budget is prepared. So we need to make sure that the collection schedule, the debtors collection schedule is drawn up way before. Similarly, payments that are expected to be made to creditors are calculated by drawing up a creditor's payment schedule before the cash budget is prepared. Now remember, in cash budgets, we said we are dealing with only cash transactions. So creditors' payment schedule is also drawn up so that we know how much we have to pay our creditors. Because as a business, firstly, we've got assets and we've got liabilities. And our creditors are our liabilities, and we need to pay them back their money for stock that must have been given to the business on credits. They need to be paid back those monies. So that is why we have to draw up these two schedules, a debtors collection schedule, which is one of assets, and then we need to draw up the creditors payment schedule, which is that of liabilities. Now, here, what is happening is that these debtors are our assets. They're paying money to us and we're receiving cash for goods that we might have given out on credit. And now money is being paid to us because they are settling their accounts. And then we also need to settle our own accounts, right? As a business, we need to settle our own accounts from our creditors, okay? Accounts that we receive from our creditors. So a debtors collection schedule is used to determine the amount of cash that is expected to be received from debtors during each month of the budget period. And then creditors payment schedule is used to determine the amount of cash that is expected to be paid to creditors during each month of the budget period. Now let us look at the projected income statement. The projected income statement is used to forecast the amount of profit that the business is expected to generate through its future operations. How much profit are we going to make in our future operations? So that's what the projected income statement is all about. It sets out the estimated income and estimated expenses for the forecast period. All right. So what do we expect to receive as income, and what do you expect to pay out, right, as expenditure? So a projected income statement helps management identify whether the business will be profitable over the budget period. Are we going to make profit? Right. The projected sales figures are satisfactory. Expenses need to be cut. All right. That's if the projected sales figures are satisfactory. We will have to make sure that we cut down on expenditure. The business can afford to hire additional staff, run an advertising campaign, and so on. So that is what we want to identify. Will we be able to make profits? Right. Are the projected sales figures satisfactory? Are we satisfied with them? Right. Are there needs? Okay. Do we need to cut down on expenditure? And finally, we have to identify whether the business can afford to hire additional staff, run an advertising campaign, and so on. So in addition, if the projected income statement of the business predicts a loss in a specific month, management can make suitable arrangements to try to minimize the loss. So we need to cut the losses in the business, or even prevent the loss from actually happening at all, because the business is not about loss, but the business is actually all about making profits. So we need to make wise decisions, hence the budgeting. The format of the projected income statement. Right, now what will be the format? Let's look. The projected income statement has the same format as the normal income statement, except that here the figures are based on future projections, not past results. Okay. Also, often several columns are required since the budget period may span several months or even years. So that is the difference between the projected income statement and your normal income statement. Okay, that your projected income statement has the same format as a normal income statement, except that here the figures are based on future projections. Okay, so that's why we say projected. So we're looking at future. Okay. Summary of the difference between a cash budget and a projected income statement. Let's look. Firstly, the cash budget is a focus of the cash position of a business. All right, we are looking at the cash positions of a business over a future period. Now, the projected income statement is a focus of the profit that a business is expected to generate over a future period. So we underline those. So cash budget is a focus of the cash position of the business over a future period, and the projected income statement is a focus of the profit that a business is expected to generate over a future period. Now, the main difference between these two types of financial focus lies in the words cash and profit. Underline cash and profit. That's most important for you to remember. So cash budget, cash, and projected income statement, profits. Okay. In the cash budget, the projected cash on hand is determined by subtracting the expected cash payments from the expected cash receipts for the budget period. So there, we need to make sure that we subtract these two. Okay, because we need to make a clear differentiation between our cash payments as well as our cash receipts. So in this particular budget, the projection is that we need to look at what is our cash on hand. All right. Okay. We need to determine that by subtracting the payments. We remove the payments and then we see what we have in terms of receipts. And then in the projected income statement, the projected profits or loss is determined by subtracting the expected expenses from the expected income for the budget period. So this one is very simple. You would even remember in grade 7 when you did the statement of net worth, right, where we had to separate between our assets and liabilities. We had to separate between income and expenses or expenditure to see what cash on hand we have, okay, or what our liabilities and what our assets are. So it's all of those kind of things. But here we're looking at, in order for us to know whether we have made a profit or a loss, we need to separate our expenditure from our income, our expected expenses from the expected income. And then whatever that is remaining will determine whether we have more a surplus or we have got a deficit. If it's a deficit, then it's a loss. If it's a surplus, then we've made a profit. Okay. Thank you. I hope this is beneficial.